What's the number one reason retirees run out of money, even with a $1 million portfolio? It's not market crashes, it's not inflation, and it's not bad investments. It's actually something far sneakier, something that most people don't even know exists. Meet Michael and Michelle, same retirement savings, same average returns, but 30 years later, Michael's broke and Michelle's got over $2 million. Now the difference? One invisible risk that nobody warned them about, and today I'll show you exactly how to beat it. Hey there, if you're new here, I'm Johnathan Rankin, retirement planner and founder of Theorem Wealth Management. And if you want to retire with confidence and not luck, then you're in the right place, because twice a week, I break down the hidden risks and real world strategies that most advisors never mention so that you can stop worrying and start enjoying retirement. And today, we're exposing the silent killer of retirement savings, and that is sequence of return risks. So let's dive in. Okay, so what is this risk exactly? Well, sequence of return risk is the danger that the market hits a downturn right before or just after you retire. It's a threat during the 5 to 10 years right before and after retirement. Now, if you're not withdrawing money from your portfolio and the market dips, that can be frustrating, but it's not fatal. But if you're retired and you're pulling income, well, those losses hurt twice as much, because you're not just taking a hit from the market on paper, you're also selling investments at a loss to pay your bills. That's a double whammy, and your portfolio might never recover. Now, let me show you what I mean. Let's go back to Michael and Michelle. They each retire with $1 million and plan to withdraw $50,000 a year for living expenses. They both get an average annual return of 6.3% over a 30-year period. But here's the twist. See, the sequence of those returns is flipped, and Michael experiences 3 rough years right at the start of his retirement, and Michelle, she starts off strong with 3 solid years of gains. Fast forward 30 years, Michael runs out of money, and Michelle, well, she ends up with more than $2 million. Same starting amount, same average return, totally different outcomes. Now, here's the wild part. If neither had withdrawn money during those down years, they'd both still have over $2 million at the end of the 30 years. But they needed income, so when the returns happened, it mattered a lot. That's the hidden danger of sequence of return risk. So how do you protect yourself? What can you do? Well, let's walk through 5 smart withdrawal strategies to protect your retirement income from this exact risk. And the first one is dynamic spending, or also known as guardrail strategy. Think of this like cruise control for your spending. When the market's doing great, give yourself a little raise. When the market dips, you tap the brakes just a little bit. This is the guardrails approach. You set an upper and lower limit to your withdrawals and adjust based on performance. Now, this gives your portfolio breathing room to recover while letting you live your life. Plus, here's a bonus. You see, most people naturally spend less in retirement. There are no longer any work-related expenses, and the average full-time in-office U.S. worker spends $51 a day on these expenses. That's around $12,000 a year that you're no longer spending. The mortgage may be paid off, the kids are out of the house and maybe out of college, and maybe you move somewhere with a lower cost of living now that you no longer need to live where those well-paying jobs are. So those lowered expenses paired with a flexible strategy like this, and you're golden. Now, strategy number 2 is making sure that you keep 1 to 3 years of cash reserves, because you've probably heard that you should keep between 3 to 12 months of expenses in an emergency fund during your working years. But in retirement, that's just not enough. Instead, consider keeping 1 to 3 years worth of essential expenses in a high yield savings account or money market fund. That way, if the market crashes in year 1 of retirement, you don't have to sell your investments at a loss. You just dip into your cash and wait for the recovery and stay on track. It's not about the yield, it's about the flexibility and peace of mind. Strategy number 3 is bond laddering, the boring strategy that can save your retirement. And this one's old school, but it's still extremely effective. It's called a bond ladder, and here's how it works. So you buy a series of individual bonds that mature at regular intervals. Year 1, year 2, year 3, year 4, year 5, each bond becomes a rung on your ladder. And the goal, instead of locking all of your money up in one long-term bond or constantly timing the market, you spread it out so a portion of your investments become available each and every year. So what happens when a bond matures? Well, you've got options. If you need income, then use the payout to cover living expenses. The market's down, refill your cash reserves so you don't have to sell stocks at a loss. If rates are up, reinvest in a new bond at a higher yield. It's flexible, it's predictable, and it's completely under your control. And that's why this is so powerful in retirement, because bonds, especially high quality ones, are generally less volatile than stocks, and they provide stability when everything else feels like it's swinging in the wind. And if you structure your ladder right, you'll always have a short-term bond coming due, ready to support you without having to touch your growth assets. So let's look at an example. Imagine you retire and you build a 5-year bond ladder. Each year, one bond matures and gives you cash. Now you're not stressed about the market, you're not forced to sell investments during a downturn, and you're not scrambling for liquidity. Plus, as interest rates change over time, each new bond you add to the ladder reflects those changes. So you're not stuck earning 2% forever. You can gradually benefit from rising rates. Now, it's not flashy, it's not going to go viral, but it works. And in retirement, boring is usually beautiful. Now, the fourth strategy is the bucket strategy. And this one, it's fun and it's easy to visualize because imagine dividing your money into 3 different buckets based on when you need the money. The first bucket is your short-term bucket. This is for years 0 to 5. And you fill that bucket with things that are stable like cash, CDs, or short-term bonds. Now, it keeps you calm during market dips because you've got your next few years covered. Now, bucket 2, this is the intermediate bucket. This is years 6 through 12. This is your bridge. Think dividend stocks, bond funds, laddered bonds. The goal here is to balance enough growth to fight inflation, but stable enough to avoid big shocks. And then bucket 3, this is your long-term, this is your 16 plus, this is your growth engine, this is stocks, real estate, commodities. You're not going to touch this money for more than a decade, so you can invest it aggressively. It's your inflation fighting machine and your legacy builder. Now, the big picture here is that this 3-bucket approach helps you avoid panic during market dips because your short-term income is safe and liquid. Your midterm money is flexible and steady, and your long-term assets, those are poised for growth. And the bucket strategy is a smart way to shift your thinking from what's the highest return that I can get to when will I actually need this money and how can I protect it until then? This strategy brings structure and confidence to your retirement plan so you can focus less on headlines and more on enjoying your life. Now, the 5th and final piece is flexibility, having a flexible plan because life isn't static and none of us can predict the future. See, markets change, health changes, goals evolve. A great retirement plan isn't carved in stone, it adapts. There are very few scenarios where a retirement plan needs a complete overhaul, but sometimes they do require a bit of strategic tweaking. That means stress testing your strategy, running simulations, and working with someone who can help you pivot, not panic when necessary. See, sequence of return risk may not be as well known as inflation or taxes, but if you're approaching retirement, it could be the most important risk to understand. And the good news is, you're not helpless. You've got strategies, you've got tools, you've got options. Just ask yourself, do I have enough cash set aside? Is my spending plan flexible? Am I protected in the early years of retirement? If not, well, we built a free retirement readiness quiz that we're going to link in the description below that will give you a real life look at your retirement. It's going to give you practical examples and tips that you should implement to make sure you're on track to avoid sequence return risk. And if you found this video helpful, do me a favor, give it a thumbs up. It really helps more people discover our community. And don't forget to subscribe, hit that little notification bell so you never miss a video on retirement planning, smart investing, or navigating life's financial decisions. Now, if you have a question about today's topic or topics you'd like to see me cover, then drop them in the comments below. I personally read each one, and I'd love to hear your thoughts or help with any specific questions that you have. And if you're ready to take the next step in your retirement journey, or you just want a second opinion on your plan, then visit us at theoremwm.com to schedule some time for us to connect. I'm here to help you retire with confidence, clarity, and purpose. Thanks again for joining me, and I'll see you in the next video.